Welcome to CIO Connect, Investing on the Tightrope. Thank you for taking the time to join us today. I'm Vishal Bika, and over the next hour, we'll explore how to position portfolios as we approach year-end and look toward 2026. We will accommodate a short Q&A session at the end, time permitting, so please do drop your questions into the chat. This is a CPD accredited webinar, and you can expect your certificates in due course as well. I'm delighted to be introducing our panelists today: Gareth Bern, Chief Investment Officer of Fixed Income; Sandile Malinga, Chief Investment Officer of Multi-Asset; and Ross Beggs, Chief Investment Officer of Equities. Welcome, gentlemen, and great to have you for the second edition of CIO Connect.
Thanks.
So, to anchor us into year-end, markets do feel a little calmer, but calm doesn't always mean simple. We've had the Fed easing in the US, we've seen tighter credit spreads, precious metals have run hard, and emerging market assets, especially here in South Africa, have held up surprisingly well. So that's the backdrop: calmer on the surface, but still plenty shifting underneath. So perhaps let's kick off by decoding the macro. A big part of this picture is policy, and whilst we've seen the Fed easing on the one side, the SARB remains fairly muted and measured, I could say, and cautious back home here in South Africa. So let's start right there, because that divergence, I guess, really does matter. Sandile, perhaps I could bring you in here and kick off with you. From your cross-asset lens, has the Fed easing shifted your regional risk budget? Mm-hmm. And where does South Africa sit within that framework?
Thanks, Vish, and it's always great to chat to you. I think for me, before we sort of run ahead of ourselves and start making forecasts about the future, I think it's always amusing and somewhat humbling to actually take a look at where we started the year, to think about some of the things that we held confidently, and we thought things were going to happen a certain way, evaluate those and actually try and learn something from that. I think at the start of the year we were quite concerned about the impending US trade war. If you remember, there were concerns about is what you have in China with the sort of cheap AI going to put at risk some of the capex that's being deployed in the US. You still had lingering concerns about inflation, so I guess we can take a journey through what's happened through the year. So if you look at the chart, from the start of Jan to maybe towards the middle of March, towards the end of March, equity markets came on from a strong year in 2024 and looked like a great start. The S&P was up almost 3% in January. You had gold actually starting to behave quite interestingly, and actually it was looking like it was heading for all-time highs. And you also had some concerns around Trump's tariff war. So initially what looked like a pretty strong start to the year ended up being fairly muted in terms of US equity returns as the tariff picture actually started unfolding. So if you remember, Trump basically put up unilateral tariffs across the board in February, and that was catastrophic. So the markets basically said, hold on a second, what's going on? The trade framework that we've become used to has completely broken. And then if we roll forward to Liberation Day, and you can see on the chart, S&P 500 is lagging, non-US equities are doing well, things are looking quite interesting. And come 1st of April, Liberation Day, tariffs are put up all over the place, the highest tariffs we've seen. We saw the highest tariffs in Jan, and now we've seen the highest tariffs that we've ever seen since the start of the 20th century. And so, an interesting thing was that at the start of the year, people would have been quite worried about US equities. But in Liberation Day, sort of the post-Liberation Day sell-off, you had equities all over the world falling. But in the recovery, it was actually non-US equities that started outperforming. And so, I'm going through all of this to just remind us that the market has been fairly worried about a whole number of things, but equities have been going up. And if we look at the picture post Liberation Day, so from April to June on the chart, gold continued to go up. And so the small wobble we saw in April gathered steam. So gold is now acting or looking like a risk asset. Traditional risk assets like equities are going up. Bonds are also not doing too badly, despite the fact that inflation is particularly worrisome and is not slowing down as quickly as people wanted. And by the way, central banks have paused their easing. And so if we roll forward again, on the chart, you can see the last phase was really characterized by people expecting some level of Fed easing. US equities have lagged this year, which was not in anyone's sort of bingo card at the start of the year. We've seen commodities actually behaving as well. So oil, despite some of the conflicts that happened in the Middle East, yes, it spiked and VIX did spike along with it. But, equities have been going up. And so it's very important to remember that. And where are we today? If we look at the valuation charts, we've had a massive re-rating, despite all of the concerns and despite the level of uncertainty that's been fairly elevated. And I'm not sure where we're going to go. And really, certainly for us, from a valuation perspective, we still think South African assets look okay. But it has been a year full of surprises.
Thanks, Sandile. And I think that just really frames actually how broad this re-rating has actually been. I mean, perhaps let's touch on credit. That's been a very topical issue as well. And, bringing Gareth here, perhaps, Gareth, credit markets have also been a point of debate recently, especially given the spreads, and how tight those spreads actually are. In your view, are investors still being compensated for taking risk at these levels?
Thanks, Vish. So let's look at the chart, which actually looks at the compensation one gets for investing in the credit markets. And on the chart, you'll see we've got both for investment grade as well as the high yield market. And if you look at that spread, so that's additional compensation you get for taking the risk in lending into the credit markets over and above the risk-free, the government rate. You'll actually see, if you look across both of those markets, we're almost at the tightest levels that we've been since the global financial crisis. So I guess the short answer is you're not really seeing a lot of compensation for the risk out there, particularly if you were exposed to any sort of default cycle coming through. And I think that's what's been really interesting more recently in the last couple of months, is that we've seen some tremors or ripples come through the market as there've been some relatively high profile defaults and bankruptcy come to market. So obviously the most high profile of these being Tricolor, which was a auto loan originator in the US, and the other one First Brands. And those are two they've kind of hit the headlines because they're fairly large and the market hasn't kind of been exposed to such large defaults. And I'll also talk about how those have rippled through the market. But maybe just the question is, looking at those defaults, I guess people are asking, is that the sort of canary in the coal mine? And are we about to kick off a default cycle? And I think the jury's still out on that, but you are seeing some of these rumblings come through. So maybe to touch on Tricolor. So as I mentioned, that was in the auto lending space. And it was very much exposed to low quality or individuals with low credit scores or non-existent credit scores, very much exposed to the Hispanic community. And obviously with the Trump immigration crackdown, that was hugely problematic for them and challenged that business model. And so you can kind of see that's a very specific business model. Maybe it's quite bespoke. You could count it off to saying it's a very niche part of the market, but you had a fairly sizable bankruptcy there. Then you had First Brands, which, interesting enough, is also in the auto space, but here with auto parts suppliers or suppliers. And there it's somewhat a different case. I mean, so what's been interesting there is just that investors weren't clear on how much debt the company actually had outstanding. And also there seems to have been some level of fraud. And again, that's kind of in credit markets, fraud is a kind of always a possibility. And there's also business models that can change, could cause defaults. But again, it was a large default that came through. And then we also had more recently some defaults in the regional banks. And these are some large loans in those regional banks, and the market reacted very poorly to that. And I think there again, the comment was fraud. And so I guess when looking at that, you kind of stack up, well, are these sort of idiosyncratic events that are happening, or is there some underlying theme or trend in the market which points to a wider problem? And so I guess that's what's been interesting to grapple with is whether there's a sign of things to come. And looking at that and thinking about kind of, well, why might the default cycle have been so low at the moment, and why are investors getting surprised or kind of looking at these defaults? And I think you go back to the kind of the financial crisis that we saw on the chart earlier of kind of pre-financial crisis, and you look at kind of post the financial crisis, all the changes in regulations were effectively to get credit off the banking system and distribute that in the wider investment markets. And what you've seen is a massive growth in private credit markets. And I think there's some questions around there, given that growth there, whether the liquidity and all the funds that have been flowing into there are somewhat masking some of the issues or result in the fact that actually there haven't been as many defaults as one would have expected. Liquidity has been very good for those companies. And now what you're seeing is a question as to with the chase for yield and people, you've seen the public credit markets, what spreads have done, that's been replicated in the private markets. What's happened to lending standards? What's going in the private markets? Kind of, is this all coming to a head, actually, that you may see some defaults coming through, as we've recently seen with some of those issues come through. The other point, just harking back to GFC, is all of a sudden with these defaults we saw, you had this alphabet soup of different structures coming through on the securitized side. So CROs, CDOs, and these are all, exactly, and these are all terms that kind of when I started in my career, ahead of the financial crisis and we had subprime, securitization was a big tool. It still is a big tool, but suddenly you're seeing these terms pop up with these issues that defaulted, and you've seen the risk popping up in places that you didn't expect because it's been securitized and transmitted elsewhere in the financial system. And I think that's also got regulators just having another look. I think it's important for investors to be questioning, well, what's actually my fund? Because am I clear what those exposures are? And I think that's created some uncertainty on that side. So just linking it back to the first question, are you getting paid enough? I mean, we would say actually you're getting paid. There's not a lot of margin of safety for any wobble in the credit space here. And actually, if you look at how we've been positioning in kind of the global funds that we run, we're actually moving up the credit quality position and actually possibly being somewhat underweight some of the benchmarks in the credit.
Thanks, Gareth. And that contrast on spreads is definitely a big one. Now, if we shift lens into equities, Ross, this year has looked very different. We've seen emerging markets and South African equities strongly surprise on the upside after more than a decade of underperformance against global markets. What, in your view, is driving that improvement?
Yeah, so I think, when you look at markets, I think there's two big things you need to consider. The first is, what does the valuation of the market look like? So I think that's always the first thing. That's always at the sort of at the top of our list. What does the market look like? Is it undervalued? Is it cheap? So I think that's the first thing to consider. The second thing to consider is, where's the market in its natural sort of cycle? So as you rightly point out, for emerging markets, I mean, effectively since the GFC, which was almost 20 years ago, we've been in a down cycle for the emerging markets. And I think, if we maybe go back to that period before the GFC, that's the period where emerging markets were doing exceptionally well. So you had massive investment to spending in China, and that had a multiply effect to all its suppliers. So, if you think about South Africa and the mining companies, the commodity companies in South Africa, the period in the early 2000s when China was booming, our mining companies were also doing particularly well. And at that time, margins were very high, valuations were very high. And so, when we came to that point of the GFC, when the market started to fall, actually emerging market currencies were pretty overvalued relative to the US dollar, and the emerging market, the equity markets were also pretty expensively valued. And so from that point, you've actually seen an underperformance of the emerging markets for the last 15 years. And that's because they started off relatively expensively in currencies which were very expensive. At that time, the US dollar was arguably very undervalued. And so what we've seen for the last 15 years is the dollar's got more and more expensive. And so where we sit today, you could actually argue that relative to its trading partners, the US dollar looks very, very expensive. Now, that period of the US dollar going from cheap to expensive has been a massive headwind to emerging markets. So, if you think about an emerging market, a lot of what we bring into the country, what emerging markets bring into the country is priced in US dollars. And so that strong dollar, strengthening dollar, has had a big negative impact on the consumer's disposable income in emerging markets. I I always like to look at the extremes of what's happening in markets. And if you look at one of the markets that's been under massive pressure over the last 10 years, it's been a market like Nigeria. Now, Nigeria's had also started off with a very expensive currency that now is arguably a lot cheaper. But if you go look at, one of the best companies in Nigeria, a company like Nigerian Breweries, it's a well-established company. The share price of that company has gone from $1 10 years ago to 2 cents, up just over a year ago. And so you can see that the margins of that business have been under pressure. The share prices have been under massive pressure. The valuation multiple has shrunk massively. And so that, I think, is a nice description of what effectively has been happening in emerging markets. You've had this long period where valuations have got cheaper, profits have been under pressure. And so where we sit today is actually, emerging markets we think are exceptionally attractively valued. And the currencies also are very attractively valued. So I think why we've seen some sort of improvement in the emerging markets over the last year is that pressure from the strengthening dollar, I think, is starting to ease. And we're starting to see a lot of the sort of emerging market companies being able to put through price increases, restore some profitability. And so the improvement we've seen, it's a very short period of time, but you're coming off very low valuations and potentially into an improving margin type of scenario.
Interesting. I mean, let's perhaps just build on that for a moment, Ross. Over the past year, we've also seen liquidity chase new themes, whether it's from AI to digital infrastructure, critical minerals. So the conversation is definitely broadened, just beyond rates and inflation. And the real question is, what here is truly structural and what is just noise? And Ross, precious metals sits right in the heart of that. They've rallied hard. Gold and platinum shares specifically have run. Do you see this as a structural shift or just a cyclical upswing? And how are you and the team positioning for this in portfolios?
Yeah, I think it's a very good question. It's a very difficult question to answer, and I'll take you through some of our thought processes. But I think it's worthwhile just having a look at the chart that we've got up at the moment. And I mean, effectively, what's happened in South Africa over the last year or the year to date is we've almost had what I call our Mag 7 effect happening in South Africa. So if you look at that chart, you can see the share prices of the top 40 index in South Africa, and sitting, clearly on the left-hand side there with massive price returns, 100, 150, 200% returns, you've got our gold and platinum companies. And so, I mean, we've had our Mag 7 effect in South Africa as well. If you've been, if you haven't owned gold or platinum companies over the last year, you've been, carried out in terms of the underperformance in your portfolios. And so, maybe just to take you through some of our thinking. I mean, typically over the long term, we've been underweight gold companies, and the main reason for that is if you look, if you go back 20, 30, 40 years back to 1980, if you look at and if you analyze gold companies, they typically haven't been able to grow their cash flows or their dividends sustainably over long periods of time, and so they tend to be, I think, lower quality companies. They do have spurts like we're seeing at the moment where, their margins shoot up and they make these extraordinary profits. But typically, when gold companies do make these large profits, they typically go and waste the money. They go into these big expansion drives. They go try acquire other gold mining companies. And so, often we see destruction of value in that cycle. So I think that's the first thing to realize. But I think one of the best decisions we've made in our portfolios over the last 2 years has been to actually reduce our underweight to the gold sector. So we've actually added to our gold weight in our portfolios. And I think the two main reasons for that: one is a recognition that the gold price is a very unhinged asset. So the gold price can double or halve for no particular reason. And the reason I say it's an unhinged asset is because it doesn't generate any cash flow. So it's very similar to things like diamonds, paintings, bitcoins that they don't generate any cash. And so it's very difficult to have an intelligent conversation about what the price of those types of assets are. It's basically what someone's willing to pay you for those assets. And so, I think that's the first thing you need to recognize about gold, is that it can move around a lot for no particular reason. And then I think the second thing that we recognized 2 years ago was that the gold price was actually acting very strangely. So, we'd had a period in the world where interest rates have been falling for sort of 20, 30 years, and interest rates started to rise quite aggressively. And at the same time, the price of gold started to rise as well. And that's pretty strange behavior for the gold price, because typically, the opportunity cost of holding gold is what you could earn in interest-bearing bonds or whatever. And so as it was very strange 2 years ago where the gold price started acting very positively when interest rates were also going up. And, I think the what we recognized at that time was that we were starting to see a lot more central banks buying of gold. And so we saw, particularly countries like China, as their sort of US bonds were starting to mature, a lot of the capital that was coming off from those bonds, they were reallocating into gold reserves in China. And so I think we recognized that at that time that, potentially this could be quite a long cycle where central banks take a potentially strategic or structural decision to increase their holdings in gold. So, I think maybe in summary, the sort of decision we came to reduce the underweight to gold was because we think, gold is a pretty unhinged asset, and we're starting to see, very big flows from central banks into the gold market. So I think maybe just having a look at the last slide that we got here, I think one of the critical lessons that we've had over the last 2 years is how important having a proper risk framework is. So, if you look at this chart that we're showing at the moment, there you can see the benchmark weighting of gold in the CAPS-Swix index. 2 years ago, that was sitting at 2%. Given how strongly gold prices have gone up and gold companies have gone up, you can see that the benchmark is now sitting 16% in the gold sector. So you've seen a massive increase in the benchmark weight of the gold sector. And so you might have said, well, I don't understand what's happening in gold, and therefore I'm not going to own any. But today where you sit, you actually now have a massively underweight or short position in gold. And so I think a key learning has been, it's critical to manage the risk in your portfolios. I think that's the key takeaway.
And avoid unintended bets.
Yeah. Thanks, Ross. I mean, definitely some key learnings over the past 18 to 24 months. And perhaps staying on this point of signal versus noise, Sandile, from a multi-asset perspective, when you balance these themes, how do you size them alongside regional calls like South Africa? And are they decorrelated enough or still tied to global liquidity?
Yeah. Oh, you mentioned liquidity. I mean, it's like, I'm always surprised at, how susceptible we are to like the latest fads, latest buzzwords, as the kids would call it, vibes. But, and you'd think, I think my portfolio manager is not going to be susceptible, but we're human. Of course, we're susceptible to this, and we're no different. But I think our job is really to focus on, what do we think are the fundamental drivers of these asset classes? Ross just made a point about a structural shift in the demand for gold, and that is clearly a change in the fundamentals of gold and gold demand and supply. And so we would then say, actually, if we put on our economic hats, there's been a structural shift here. And there's bound to be a shift in the equilibrium. And so what do we think about that? And should we be doing things about that? Right. And so, liquidity is one of those things that people like to talk about. But, really, we tend to focus very little on that. We certainly in multi-asset, try to focus our attentions on the sort of medium to long-term things that tend to drive asset classes in aggregate. So things like trend inflation, things like movements in risk premium, the level and change in the risk premium is very important. Things like the level of real short rates, it's the opportunity cost of capital. And so if that's going up and down, what does that mean for your valuations? And what does that mean for, the relative attractiveness of assets? Things like GDP growth, very important for earnings growth. And so we have to pay attention to that. And so it's less about, what is the topical thing, but really, and it sounds boring. I know I do sound like a stuck record sometimes when you come to my desk, but it's very important. And so our job is to then try to figure out, from this noisy stuff, this noisy information that's coming in, what is the translation of that into sort of structural underlying drivers, and what do we think that means for valuations? And so this year, I think, liquidity has been one of those things that people have forgotten about. I mean, I'm old enough to remember when, 2 years ago, people were drawing all sorts of charts. I think we have a chart of that where people were looking at, Fed balance sheet, the size of the Fed balance sheet, and trying to draw correlations between that and, US equity market performance. Just because the two lines are going up between 2020 and 2021, they're going up together, people were trying to draw some causal relationship. And no one does that anymore. Why? Because it was a spurious analysis to start with. So you have to be beware, of being caught in these fads and vibes. And what are we focusing on at the moment? I think, if we look at valuations have really shifted. And so starting valuations at the start of the year were quite attractive. Emerging market equities were quite attractive. In fact, I'd say non-US equities were quite attractive. And what do we mean by attractive? The real yield on offer or the real return on offer was higher than what we would say is fair. And if you cast your mind across those asset classes up on the chart, you can see, those bars that were above the dot were cheap. And so if you look at our portfolio and how the portfolio looked at the start of the year, we were leaning into a lot of those. Yes, liquidity plays a role, but we don't think liquidity is, an underlying structural driver. And so, as we set out at the beginning, a lot of those assets have had a correlated rally. And if you look at changes in valuations, I think it's only really, if you look at the chart, Japanese 30-year bonds that have gone up, everything else has collapsed. And so, yes, there has been a correlated rally. And what does that mean for our positioning? Well, we tend to get worried with those things because, if there's a correlated rally, it tells you, there might be structural reasons in the case of gold, for example, or in the case of equity earnings that have actually surprised on the upside in various places. But generally, that seems to be quite a frothy market. I'm not calling a bubble, but I would say the positioning in our portfolios is quite tight. We have enjoyed some of those rallies. And the really tricky conversation for us, certainly in Q3, was we've seen these assets do well. We felt very clever about ourselves. We're having a good time. But what do we want to do with the capital? And so we've kept things quite tight, where fundamentals have gone way ahead of valuations have gone way ahead of fundamentals. We have sought to reduce the capital there and sort of stay in cash and wait for opportunities to redeploy. Because as we know, there is a crisis around the corner. No one knows when the crisis is or what's going to look like. It might be Gareth's credit cockroaches, as someone said the other day, or it might be collapse in the gold price causing issues with gold company earnings, and we will be ready. We'll have the capital to deploy. We will have our own liquidity to quote you. But I think valuations at the moment are a little bit trickier than they were at the start of the year.
Okay, so let's stay on the point of capital and deployment, and let's make this slightly practical for a moment before we move on. Because at the end of the day, every year in hindsight, I'm sure we all, reflect and look back and think, there were a couple of positions that, that perhaps worked, some calls that worked, and perhaps, some positions that we potentially would have wanted to size, slightly bigger. So perhaps some reflections from each of you on this. Ross, perhaps I could start with you.
Yeah, I think it's in the equity markets, I think it's been sort of pretty obvious of what you should have owned. So, it's been sort of obvious to own the US market, and the part of the US market that's done exceptionally well has been the Mag 7. So, that's been where you want to be positioned. And, in South Africa, very similar. You wanted to own what I call the Mag 7, the sort of our top 7 gold and platinum companies. That's where the returns have been. I think I think the more difficult question, the very difficult question at the moment is, well, are you going to own the Mag 7 in the US or the gold and platinum companies for the next 3 to 5 years? I think that's the critical question that you need to think very hard about.
Sandile?
Wow, you want to see my warts, so I'll give them to you. I think, like I said, we had bucket loads of SA equities in the portfolio, so we're feeling quite clever about that and quite happy with that. Within our sort of global portfolio, we've had a massive underweight to US equities and a massive overweight to non-US equities. And despite the fact that, the sort of outperformance in the US has been tech related, we've actually found, non-US equities have outperformed US equities. So, quite happy with that trade. Things we sort of wish we'd own more of, I think closer to home, SA listed property is an example. Fundamentals improved, on the margin and taken together, painted a very different picture than to what the sort of listed property companies were facing 2 years ago. And so we were a little bit late on that, but, we can't get it all right.
Gareth?
My answer is the same for both. It's bonds and more bonds. Vish. So, SA bonds have had a stellar sort of 18 to 24 months almost. If we just cast our mind back to last year, the All Bond Index delivered 17%. This year, kind of year to date, we're almost at about 14%. So bonds is where you've wanted to be. So if you could have owned more bonds, that would have been a good thing in fixed income portfolios. I do think it's important just to recognize that it's easy to say in hindsight, right? That's what you want. And I think all of us kind of said in hindsight, we would look back and say, what is the thing that you want to own? It's the thing that's done the best. But clearly that's not reality and that's not the world we live in. So it's important then to kind of say, well, that's not what you're going to be able to deliver. I think Annie Duke talks about the quality of decisions, and you can't measure the quality of a decision based just on the outcome. And it's important to understand this when one's constructing a portfolio, you're doing that in the knowledge that you actually don't know the future and you don't know how things are going to pan out. So by default, we're never going to own as much as we probably would have wanted to in hindsight. But that's part of building a resilient portfolio, a portfolio that can kind of see you through the times when you actually get it wrong. Yeah. And you can be happy that you didn't own as much as the thing that you thought would do fantastically well, and it doesn't. So you don't want to kind of manage with regret in mind, but really resilience.
Okay. Hey Gareth, staying with you for a moment, perhaps let's just come back to credit and South African credit in specific. Do you feel investors need to dial back return expectations, or do you feel there is still sensible yield to be found?
Yeah, so I think it's touching on kind of what I was talking about. I've just talked about how well bonds have done, and I think that's important in the one aspect to say you've had fantastic returns delivered from SA government bonds. That's not to say that you can't have good returns going forward, but one does have to pare back their expectations given the significant rally that you've had. And I think that's important for investors who are thinking about what their portfolios are going to deliver to bear that in mind. Is the starting yields obviously are much lower now, so you should bear that in mind. And do the bonds still have the capacity to rally in that same manner that they've done recently? Arguably not. Your margin of safety on that is probably a bit lower. I think it also touches on the SA market, and this particularly for investors in the local market in respect of credit. So we talked about globally in the credit markets and how spreads are quite tight there, or there's not a lot of margin of safety. That sort of mirrors what we've seen in the South African market for some time now. So it's been a very similar story of spreads compressing over a number of years. Maybe the dynamics are slightly different in the local market, but it really is a kind of a lack of supply in the local market. So if we kind of just look at corporate issuance over some time, and we were recently in one of our morning meetings just running through what that's looked like. It's been anemic, right? So there's been very little of corporate issuance kind of over a very long period, and you can talk about that reflective of what's been happening in the economy, and very low growth. So companies haven't been expanding. There's not a lot of investment, so there hasn't been that much of credit issuance. So the problem has been supply, and then you kind of contrast that with the wall of money that's gone into income and multi-asset income funds, which are all looking for some sort of credit to enhance those portfolios, and there's been massive demand. And so you can just kind of see that in spreads throughout the credit market, how those have come down. So just to give an example, if we looked at bank capital instruments, so the AT1 instruments, which are kind of in the fixed income market, the most risky part of the bank capital structure you can invest in. If you go back just 2 years ago, you were probably earning about 350 basis points over JIBAR. So a healthy return there. You kind of dial back to a year ago, you're looking at around about 300. And the most recent issues now, you're looking at 250. So material compression in those spreads, and that's replicated in all parts of the market. So I think That's the one aspect. So the returns, you just need to pare back your return expectations, both from what the bond portion of your fund can do, as well as what the credit portion can do. But I think it's also important for investors to reflect on how their managers are positioning to address the lack of yield that you've got on credit and potentially from the bonds. So you need to be clear whether you're now reaching for yield. And so you can kind of look to say, well, what's happening? And are you concentrating exposures in particular names? Are you increasing your risk budget to try and take on more risk to get yield? Because obviously it's more challenging now to outperform the benchmarks that we have. And it's interesting just to note the growth over this period in structured notes. So we've seen a massive growth in structured notes. So these might be CONs, so there's credit linked to some other names there. You've seen repackaged vehicles where they're taking government bonds and repackaging them in. And I think it's important, and we've written about this actually, for investors to ask some questions about when they see sort of what looks like cash instruments delivering bond-like returns, and understanding, well, why do they have cash-like return profiles and volatility with bond-like returns? Something doesn't gel there, and you need to be aware of what the risks are on that side. So I think it's important kind of to close out that question essentially, is that investors need to pare back their return assumptions. We've had a very healthy returns, or we've had very healthy returns over the last 2 years, but you need to kind of, where we're starting now, I think it's realistic to expect that those returns won't be as high. That's not to say that kind of fixed income assets aren't giving you a good real return, and cash is kind of real cash rates are still high, but relative to what you've experienced in the last 1 to 2 years, you need to pay back your expectation.
I guess finding value in such a crowded market does get challenging. Sandile, let me bring you in here. What would actually trigger you to add risk meaningfully from here? And on the flip side, what would make you take risk off quickly?
Off quickly?
Yeah.
If we have another 30% rally, then yeah, we'll take some off. Thank you very much. I mean, you know what I'm going to say, right? You know, the valuation chart is there. You can see how much of the re-rating has happened in equities and how much bond yields have fallen this year. And so, and I mean, mind you, this has happened in a correlated fashion, which is quite strange. So, you know, to our minds, you know, we sort of, on the tactical side of things, tend to probably play the valuation signals more from a sort of contrarian point of view. So you'll find, you know, it's quite a lonely endeavor, because, you know, when things are cheap, we're buying bucket loads of stuff, and it is uncomfortable. And sometimes our clients rightfully ask, you know, uncomfortable questions about this. But today, I think we have enjoyed a rally. And so our positioning is, you know, like I said, very tight. You know, our tracking errors are quite low. The active share in our portfolio is quite low. The duration is also quite low. And so, you know, when would we deploy capital? If we had a 20% pullback across the board, I think we'd probably get interested, with the proviso that obviously the underlying fundamentals are still intact. And yeah, we really like short, sharp moves, and short from a sort of time dimension, right? Because those are typically led by one story. So typically this year we've seen there's been tariff-related sell-offs, and if you had bought equities at the bottom of the tariff-related sell-offs, so maybe the 9th or 10th of April this year, you're doing pretty well. You know, it's great returns. And yeah, we're looking for those opportunities.
Thanks, Sandile. Perhaps now let's shift scenes to sustainability. Rosk, if I could bring you in here from a stock picker's perspective, what is key and top of mind for you currently within South Africa from an ESG perspective?
Yeah, I think if you look at emerging markets and South Africa in particular, you know, I think what's important to focus on in particular in these markets is often the sort of social risks and opportunities. And, you know, one of the top of mind social risks that I see in South Africa at the moment is just the massive explosion that we've seen in online betting. So we've got a chart up that you can look at, and, you know, really since COVID, we've seen a massive explosion in the number of people and the size of bets that people are putting onto online betting platforms. And you can see from this chart, you know, we've gone from COVID, where before COVID there was actually very little online betting, it's moved from there to almost 50 billion rand, we estimate at the current run rates, that people are losing to online betting sites. So, that's just the amount of money that people are losing in South Africa at the moment. If you think about the size of the bets that people are putting onto these sites, we estimate that it's probably close to 1 trillion rand that people are betting on these sites all the time and losing 50 billion. And 1 in 10 South Africans have got an active online betting account, and it's putting massive pressure on consumer disposable income in South Africa. So, money is being directed away from groceries, from clothing budgets, onto these online betting sites. And I think if you look at the second chart, who are these people who are betting on online betting sites? The vast majority of people are low income earners. So, we estimate over 80% are consumers earning less than 10,000 rand per month. So, the natural question then is, well, what can we do about it? What can we do about this massive explosion in online betting? And I think the first thing is just to make people and the regulators aware of this issue. I think it's starting to come to light now, but it's been a rapidly growing industry, and I think it's important to make regulators aware, and also to try pressure potentially a change in regulations around these online betting sites. So I think there's a lot that regulators in South Africa can do to improve the regulations around online betting, given how sizable it's become. I think the other thing that we can do is, if you look at the sort of gaming levies and taxes that these online betting companies are paying, they look to us to be unreasonably low. And so I think if you look at a country like South Africa, it's almost it could be an easy win. We've got a government who's talking about increasing the VAT rate to try and generate more income. Surely it's more sensible to potentially look at the online betting levies and taxes to make sure that they pay their fair share of taxes. And so, I think those are the two things that we sort of try to actively engage in at the moment. To bring this to people's attention.
Thanks, Ross. And I guess if these social costs, if they ultimately find their way back onto the state's balance sheet, then this stops being a soft issue, and then it becomes more of a fiscal design question. So it becomes an increasingly bigger problem. Perhaps, Gareth, shifting back to you and bringing you in here, how should we be thinking about the way South Africa designs tax and revenue architecture a bit more responsibly?
So, Vish, I think that's a big question. And I'm not going to answer that in kind of here. I don't think I'm an expert in that. But I think just to touch on kind of the work that Ross and his team have been done, and I think you've done some good work, you and your team, in raising the profile on this. But I do think there's something perverse almost. If you look at sort of the headlines and you're seeing the news reports and some anecdotal stories, essentially that a number of people with social grants, not housing allowances, but students with student support, spending those cash transfers that are coming from the fiscus onto the online gambling world. And so what effectively you've got is a transfer from National Treasury and the fiscus to online sports betting or other forms of betting. And there's something perverse around that, because essentially, the policy makers are obviously trying to address an issue, and with the social grants as well as student support. And this isn't obviously what was attended. And so I think what Ross was just alluding to is something, certainly I think there's space there for the regulators to have a look and understand, what needs to be done on that side. But there's also an aspect of the fiscus to look at, well, how do you tax these entities? Are we actually kind of losing money in terms of this? And are we channeling money that is coming from social grants into the wrong sort of entities? And, I think that is a question which I think with all the high profile nature now being raised, Ross's team elsewhere in the media and the like, that hopefully this gets the attention that it deserves.
So let's pause here, and I think let's turn to the audience, because I do believe that we have a few questions in the chat. If I could look at the first one. So the first one is, given South Africa's significant exposure to China, what do you think are the future growth prospects to China? Ross, perhaps I could pass it on to you.
Yeah, sure. I think if you look at China, if you go back a couple of years, there was a very large U.S. investment bank that said that China was uninvestable, and I think we couldn't disagree with that point of view more. And I think there's in my mind there's two big reasons why I think the prospects for China do look good. And the first thing I think is, if you look at China and the consumers in China, they save a huge amount. So China's got one of the highest savings rates in the world. And if you just look at the cost of debt in China at the moment, it's exceptionally low. So, the Chinese government is issuing 10-year bonds, or the 10-year yields trading under 2%. And so, the government can raise and companies can raise a huge amount of capital at very low rates. And I think that, we've seen a decline in the housing market in China. A lot of money's, is not being channeled in the housing market anymore. It's, it's being, saved. And I think there's a potential massive growth engine in the amount of that savings and the very low cost of those savings that could continue to drive growth in China. The second reason why I think China could continue to be very successful is just their long-term view. So they tend to take very long-term views about investment. They're willing to suffer the short-term pain with the long-term view as the ultimate goal. And I think one of the examples I like to use is the shipping container industry. So, if you go back 20 years ago, there were lots of countries around the world, lots of companies making shipping containers. We used to produce a few shipping containers in South Africa ourselves. And if you look at what China's done to that industry, over the sort of last 20 years, have effectively consolidated the entire shipping container manufacturing industry around the world. So, today, if you buy a shipping container, there's effectively only 2 companies in China that you can buy those shipping containers from. They produce all the shipping containers. And initially, those Chinese companies making containers lost a lot of money. They weren't profitable. They weren't profitable for a very long period of time. But now that they control that market, those companies now earn a very decent return. So, I think that those two things, I think could be very important drivers for China going forward. One, that very low cost of funds to drive growth, and then that long-term mindset. And we're sort of seeing that at the moment in the car market, in car manufacturing. China's making massive leaps ahead in that market.
Okay, I think we do have another question. So there's another question here. As the rand continues to strengthen against the dollar, how have your offshore allocations changed? Sandile, I think that's a question for you.
I was bracing for that one. Yeah, maybe like a technical correction. It's really the dollar weakness that we're seeing rather than overt rand strength. So if you look at trade-weighted rand versus a basket of currencies, you can look at it in nominal space, or you can deflate it for inflation over time. It's not as strong as the sort of strength of the dollar rand exchange rate. So let's just keep that in mind a little bit. I think there's 2 decisions to make when you are investing offshore. The first is, do you think the current rand level is cheap or expensive, which is a big call. And then the second is, once you have either decided to take your capital offshore, what are you buying with it, right? And so as valuation-based managers, we look around the world. You've seen our valuation chart. Probably put it on screen. This is how we look at, different assets on the same basis. So we can compare both the relative attractiveness of different assets in different geographies and jurisdictions to each other, as well as their valuations versus their own history. And so the challenge for us, and certainly the challenge for us sitting in SA for the last 3.5 years, has been facing these really cheap valuations for South African assets, a cheap rand, and relatively more expensive global assets. And so at the start of 2022, you had global bonds trading at negative real yields. You're guaranteed to lose money there. You had global equities trading, most of them, either trading at their fair values or significantly below that. And so, the question was, yes, you might want to take your money out because, Rand Regulation 28 says you can take up to 45% of your capital if you're using pension fund money. Our question is, what are you going to buy? And is that thing that you're going to buy either a bond or an equity or something else? I know people are like, buzzwords like private equity and hedge funds and all that stuff. Are those assets going to outperform the obviously cheap, and I say obvious because it's obvious in hindsight, as Gareth sort of touched on, the obviously cheap SA assets? And so the current strengthening that we've seen, yes, it's been pretty good for South African assets, but on the main, we still think the relative valuations are still in SA's favor on the margin. So the re-rating we've seen has been, like we said, quite correlated. So all assets have done well. And so relative to each other, we still think South African equities look all right, South African bonds look fine, but there's a question mark about the Rand. If the Rand was at 13, probably have a different conversation.
Thanks, Sandile. The next question we have is around Trump. So Trump's tariffs are inflationary. Can the Federal Reserve increase rates in response? Gareth, I'm not sure if you'd like to take that question.
Yeah, I'm happy to go with that one. So I guess two aspects that it's touching on. Obviously, the statement that tariffs are inflationary, and I guess that's making this call that that's all that matters for inflation. So yes, I agree. Tariff, all things being equal, that's inflationary. I think important for any central bank then is to look at what the second order effects are. So yes, they might be inflationary as a once-off, but central banks look through that, and you need to understand, are they knock-on effects? So do consumers and producers look to increase prices, wages on the back of that? And so that's key in deciding whether actually it is inflationary or not. But I think what the question is actually getting to is obviously Trump's position that actually he wants lower rates, and meaning that the central bank is not going to be independent. And if there was a spike in inflation, they wouldn't react in the way that investors would expect. So I think that's actually what the question is touching on. And so I think if you just look at the market, I guess if you look at breaking inflation expectations, you look out the curve and that, you haven't really seen a move there that kind of the investors are saying that actually we don't buy into the federal bank's independence, and you would expect to see kind of a huge premium being placed on that if there was kind of any wobble in that kind of that certainty. And so I don't think investors necessarily are saying they particularly concerned around that aspect. They still buy into the fact that there's central bank independence, but clearly the risks have increased. And I think our colleague Leonard Kruger did a very good piece earlier this year, just looking at central bank independence. And I guess it's a topical question for many economies that are looking at where the fiscuses are stretched, debt to GDP is very high. And there's this question as to, well, what are these countries going to do? And obviously one of those aspects is always the ability to inflate oneself out of those troubles. And that means kind of you need to have a hold of the central bank. And so I think that's a very pertinent question. And I think clearly the risks have increased in that regard. But certainly as we stand at the moment, I think the market still is looking and saying, central bank independence is still there. The Fed is obviously in a rate cutting cycle at the moment, although we're looking through to the December rate cut. And if anything, you want to see that there's potentially a pause there, and the market was expecting a cut. So that might talk to, well, there is some independence on that side.
Great, thanks. I think we do have time for one more question. There is a lot of talk about markets being in bubble territory. What is your take? I'm not sure, Ross, if you don't want to take that one.
Yeah, I'm happy to take that one. Yeah, I mean, there is a lot of talk at the moment about markets being in bubble territory. And, I think if you just look at the Magnificent Seven in the US, the market capitalizations of just those 7 companies in the S&P 500 is more than a third of the S&P 500 index. So I think naturally, good question to ask when just 7 companies comprise, more than a third of an index. I mean, even if you go look at the all world index. So, there you think you're buying, I've got 2,000 companies across 40 countries. Again, there, the Mag 7 are over a quarter of that market's capitalization. So, clearly a question that does come to mind. Are these valuations is there a bubble in these markets? And I think maybe the one thing I will sort of maybe just touch on quickly is, if you look at the capital expenditure of these Mag 7 companies, it is actually very, very substantial. So, at current run rates, they're looking to do probably close on $400 billion in the coming year on capital expenditure. And maybe just to sort of put that in perspective, after World War II, the US, via its Marshall Plan, offered or undertook to help rebuild Western Europe. And in current money rates, at current rates, they were spending $40 billion per year to rebuild Western Europe. Now, if you think about that, compare the $400 billion that these companies are spending to the cost that it the cost that it cost to rebuild Western Europe. It's a very, very substantial amount of money that these companies are now spending on things like data centers and artificial intelligence. So these companies have gone from hoarding cash to now spending huge amounts of it. And, the multiplier effect that can have across economies, across countries can be very significant. And so, I think it's, who knows how long the spending goes on for, but I think valuations are clearly elevated for these companies. But I think you could expect that this could go on for a while.
Thanks, Ross. I think it brings us to near the close of our session, and this has been an insightful discussion. So thanks so much for your time. Just in closing, perhaps one line each, your single most important positioning call heading into 2026. Gareth, if I could start off with you.
I'm going to touch on what I talked about earlier, but just certainly in the fixed income market in South Africa, recalibrating your return expectations and ensuring that your risk budget is appropriately sized as a result.
Okay. Sandile?
I'm going to sound very similar to Gareth. Valuation's your friend. And so rallies tend to borrow returns from the future. And so, you should be looking at, keeping things quite tight, paying attention to changes in valuations and changes in fundamentals, and really, try to buy cheap things that people don't like but have solid fundamentals.
Ross?
Yeah, and from my side, I think in South African equities, one of the key questions or areas that we're focusing on is how much capital do you want allocated to the sort of typical rand hedges, the Naspaces, the Richmonts, the BAT, relative to how much you want allocated to the sort of South African interest rate sensitive sectors. So I think, we think the South African interest rate sensitive sectors are looking increasingly attractive. Sectors like our bank sector. We're seeing bond yields coming down in South Africa, and I think that that sort of positive momentum, if that continues to drive through in the South African market, I think South African SA focused industrial companies, banks, property companies could do particularly well. So I think that's a key call for us in the coming years, is how much offshore, how much rand hedge, how much to the SA interest rate sensitive sectors.
Thank you, Ross, and thank you all for your time today. It has been an insightful discussion. And thank you to our audience and our listeners who have dialed in. And most importantly, thank you for your support and the trust you place in M&G Investments. A recording of the session will be available. As well, we will share your CPD certificates after the session. A post-survey feedback will also be shared, so please do feel free to participate in that. We do appreciate it. Thank you very much, and we look forward to seeing you at our next webinar.